Let's drink some coffee. Let's pump some iron. Let's start a company. It's Coffee Moguls. It's Coffee Moguls. Welcome to Coffee Moguls, a new show bringing together the brightest minds in technology and finance to talk about starting new initiatives, making money on the internet, and investing in markets. I'm Nathan LeClaire, your host, a programmer turned quant with a fascination for the world of business. Join me as I interview moguls from around the globe to understand their adventures, what makes them tick, and what's front of mind for them for new opportunities. This podcast is for entertainment purposes only and is not financial advice. The opinions are personal and not professional advice. Do your own due diligence and seek professional investment advice. Today is June 19th, 2021, and on the show today, we welcome Faraz Yashar, also known as YOLO Quant, for a chat about selling volatility to Redditors, scraping social media data to profit in the markets, and where he thinks the Fed's new hawkish stance will take us next. And I'm just fresh back from a trip to Miami, Florida, the cultural hub of Miami, and that was an interesting experience. Might do a little recap about that, but part of what I did there was I happened to meet a new friend. And so I'm happy to welcome this week to Coffee Moguls as the guest, the one and only Faraz Yashar, also known as YOLO Quant. How's it going?
I'm great. How are you?
I'm doing well. I'm just still in the happy after effects of that Miami trip. That was quite a trip. So I'm sort of in recovery mode.
Did you escape without a sunburn?
Not really. If I spend like 20 minutes in the sun, I pretty much get sunburned. So Miami was not great for that. Although I was surprised that it was so rainy there. I guess it makes sense because it's like a monsoon climate, but I wasn't really expecting the level of rain that we got. It was really rainy.
Yeah, we'll stick around for hurricane season and you'll get a little bit more of that.
There you go. Yeah. And so are you a Florida native?
Yeah, I was born in New York, and then at about the age of 10 months, my parents cut out of there and moved to Florida. And I've been there ever since. And, of course, I went to school in North Carolina and still do a lot of work in North Carolina. But yeah, Florida's been home for a long time.
Got it. Yep. So you probably have interesting opinions on this sort of tech industry, Miami hype. That's one of the reasons I wanted to go check it out, was see what all the fuss is all about. But first, before we get into the interview, why don't you just tell us a little bit about your background and like what have you been up to? Why are you a person of interest?
Yeah, so I, originally started out here in Florida, ended up at Duke on a scholarship, and about a year after being at Duke, I dropped out and joined a startup along with a Major League Soccer coach and a former college player. And the entire goal there was, how do you incorporate sports analytics into decision-making processes in soccer? And that started out with, training optimization for teams, and then eventually ended up turning into sort of like a recovery monitoring platform to figure out what players should be put on the team, taken off the team. How much pressure can you put in terms of training on different players without them overexerting themselves? And that basically blossomed into us working with U.S. Women's national team when they won the World Cup in 2015. And sort of after that really big win for us, business wasn't really growing the way that I was expecting it to. People were afraid of bringing capital in to really make things accelerate forward. So, I decided to go back to my academic roots and sort of dig into things in math that really interested me, dig into the machine learning. And that led me to work on a few different projects with some really good friends of mine at Duke Hospital that were in this sort of intersection of healthcare and machine learning. And that's really where I've spent the bulk of the past, maybe 4 or 5 years. And, part of that was actually going back to school because, in talking to some professors, they had convinced me, hey, you should go finish your degree so you can come back and do a PhD. So, after that sort of like stint of having been in industry and coming, back to school, one of the sort of interesting things was different perspectives that you have and coming back and sort of seeing things. And one of the really interesting things was that, when I graduated, that was the tail end of that was when the pandemic had actually started. And I, at that point in time, decided to get really heavily involved in equipment procurement, figuring out how to help relieve things on the ground. So for the past year or so, I've been running a very small company that was sort of a spin out from Duke. And our job was really to help facilitate on the ground efforts to help with different things, the pandemic, in terms of helping people get access to testing when it was so difficult to get access to testing, help people get vaccinated, help connect schools to different social resources like food, helping people get paycheck payments during the times where they were sick because they had COVID, things of that. And really, I'm sort of like looking forward to new opportunities now the pandemic is over. So that's my background in a nutshell. And really, like the start of the pandemic is really when I got heavy into options and sort of understanding other market mechanics. Because before I was like a fairly vanilla trader, right? Like I had the bulk of my accounts were in index funds, and there was maybe a small portion that I'd trade on the side. And I have good years, I have bad years, and didn't really think of it as any place where a real edge existed, mostly because the whole efficient market hypothesis had been dinned into my brain, and I sort of accepted that as truth.
Yeah, which may well be a good call. I think. But 2020 was a really particularly unique year in that way. And so one of the things we were talking about when we met was some of these volatility selling strategies that you embraced, and then also having a bit of a mathematical side to it. So why don't you tell us a little bit about, what kind of stuff that you were doing in trading and what worked really well for you, maybe what didn't work?
Yeah, so my whole story of getting into options was that when the pandemic was sort of brewing in its very early stages, I took a very heavy bet against like just global markets because I didn't think that they had priced what the effects were. Japan was debating whether or not to lock down. It wasn't something anybody seemed to be taking seriously. At Duke, there were conversations being had about shutting down certain campuses in China that they have because they have a campus there. It's Duke in Kushan. I can't actually remember it precisely, but the name precisely. So all those things tipped me off that okay, like maybe this is a time short the market, and I'm looking for a way that's risk defined. And that's sort of the selling point of options to most people is that your upside or downside is limited, but your upside is unlimited. And I'm like, wow, this is a great instrument. I'm gonna just give this a shot. And I sold like a few puts, like nothing incredible. And when you experience how the price of an out of the money put sort of accelerates, as it goes in the money, that's like a really huge high. And I became much, much more excited about that as the pandemic kept going. And whenever Trump gave a speech, there's sort of like an opportunity to put on a new trade. And in sort of all of that excitement, I never realized or understood what the mechanics of this option was that I was buying. To me, it was just like this is a payoff profile, right? Like I wasn't ever thinking about like what the option premium was doing. All of that was sort of by the wayside because I'm like, oh, this is a short bet, and I got burned really badly because I basically didn't. I traded a product I didn't entirely understand in the second and third and fourth trades just because volatility had expanded so much. And that basically ate into almost all the profit that I had made from that initial short bet, right? So it was a really huge lesson. And that sort of transitioned my thinking into, well, there must be some other person that's taking the opposite bet of me, right? That has to be the case. So I want to understand like what they're doing, how are they thinking, and understand what are the mechanics of this thing that I'm trading. And that's when I got into like understanding Black Scholes, understanding what all the Greeks were. And it also led me to realize that there were, opportunities in terms of selling volatility just because volatility itself was really, really elevated. And the second place where I got really excited about selling volatility was in meme stocks. Right, this is before meme stocks became meme stocks, around the time when Hertz was trading, and really trying to sort of figure out like where does it make sense to sell calls, well, where does it make sense to sell puts, and trying to
Yeah,
hard.
and actually, I'm gonna maybe interrupt you there. And I don't know if everyone who's listening will be familiar with this jargon of meme stocks. So maybe you could just give us
Yeah,
a quick rundown of what meme
yeah.
stocks
So
are.
meme stocks are, and this is the term that has sort of come to be. Is just these are stocks that for no sort of fathomable reason their price accelerates and the internet becomes so excited about them that the name becomes hyped and the name ultimately ends up in the news. So Hertz was like the first example of this. Then of course was GameStop and AMC and all of those types of names. But I mean, even before then, I think things like Palantir are a really good example. Basically, anything that Wall Street Bets and that entire online Reddit crew got really excited about, like there was an opportunity there. And not like what people would typically do, which is people are like, oh, these guys are buying calls like maniacs, right? So yes, it's true that like you could sell calls to them just because demand for calls are rocketing. But what the rocketing price in calls does is that it actually causes like a simultaneous rise in put prices. Okay, and this is in part
Right. Well,
because
it's just all volatility,
right, all
right?
volatility
Like
goes up.
all the volatility is rich.
Right, exactly. So the way
Yeah.
that I looked at it was that like, okay, there are put prices. There's a put price where like based on if you look at like a chart, if and you see where it's been trading for such a long time, right? There's a place where I could sell like a ton of puts and vol is rich there. And my risk is limited because like I don't think the price is going to come back here at all. Now, I will say that the risk of a strategy like this is like what happens if, and what I was really afraid of is what's going to happen if they all of a sudden unload more shares. Then in theory, that original price isn't true anymore. But the market has kind of showed me that nobody gives a damn about that. Like over time, like Kodak was another example, Hertz was another example. Like it was just impossible for the stock to go below a certain threshold no matter how anybody tried. So that's where you sell puts, and then maybe if you're feeling gutsy, you'll sell a call here or there after things have calmed down and you're not scared out of your mind, given the fact that the risk of selling a call is just astronomical if the price explodes,
Yeah.
right? And
Yeah. And so was this part of a spread, or were you delta hedging? Like how are these trades
it
structured?
depends on how much margin the trade takes. That's what would dictate to me whether or not I should sell a spread. So like for example, like if when I started selling puts, when did I start selling puts on GameStop was when I was getting a signal from scraping Reddit that people are like pumping GameStop. Okay, so like I bought some GameStop, but at the same time I was like waiting for this moment for volatility to spike and start selling puts at the price that it was trading at, where everybody said this is fair value for GameStop. So this is like around 20-30 bucks. Just start selling puts. Okay, and what at that price, like I can have a pretty well sized trade just because the risk is that 20 bucks. Like that's all the risk that's there. Now that GameStop is trading in the 200s, like I can't, if I were to like put a spread on at like 50% of the price, that's $100 of risk, right? And I can't put that if I want to put that trade on in like with relative size and have other trades on in my portfolio, like it's gonna just chew up all my margin if I'm doing that. So that's where I have it in a more risk defined way because that entire tail is where like I'm not gonna get that much premium and yeah, I have a little bit of a hedge built in to where my broker isn't saying, hey, you should have every single dollar you know, up for the trade.
Right. So you're kind of describing how naked option selling, right? Selling an option without any hedge or without any offsetting position or leg is an unlimited risk strategy, right? Where that thing could move against you and you could end up way, way in the red. And so therefore your broker charges a certain amount of margin to protect themselves.
So there's a buying. So I guess the best way to say this is that any stock can go to zero and it can go up in theory to infinity, right? Or to like a very, very high price. Okay, so as your broker on a stock that is extremely volatile has some model internally that says like what is the probability of this actually getting to certain prices. And on a margin account, what they'll do is they'll only take away for a trade a certain amount of buying power that corresponds to that risk. So, for example, you can sell puts on gold which is like or you can sell puts on like a 10-year treasury future, which is an extremely levered product. I know this for gasoline, for example. Like gasoline is like one contract is like roughly $88,000 is what a contract is, but you'll only put up like $1,000, right? But the reality is that if you were to sell a put on that, your broker isn't going to ask you for all the margin just because the volatility isn't that high. They're going to say, okay, you need to have 10 grand up for this position at this point in time, given where it is. And depending on how it moves, I'll ask you for more or less money. With GameStop or any of these other stocks that are trading like AMC now at insanely high volatility, there is a very real chance the thing drops to, 20, $30. So they demand that you have absolutely every single dollar there for the trade, right? And because of that, it even though I don't think that's actually true, it's being priced that way. That's where I would put a stop. I'd sell a put at like say $100 and then buy a put at $80. Okay, and that gives me only $20 worth of risk that I have to absolutely have cash for. Yeah.
Yeah. Yeah, it's just kind of like how one thing that I've noticed is the Bitcoin futures that you can buy on certain exchanges. They require you to put up like I think half of the value of the contract or more because that's such a volatile instrument compared to treasuries where you can essentially be levered like, I don't know how much it is, but a lot because it's like lower volatility. Treasury, although this week was a little different in that way, usually doesn't move around that much. And so you did pretty well selling volatility, and you kind of alluded to something that I think would be really interesting to get into, which is that one of your advantages in this strategy is you're doing kind of scraping of social media data.
Yeah, so this is a strategy that worked for a period of time and now has like mixed results just because everybody knows about it. And it's really hard to get good signal on, what the next move is. But basically, what you could have done at one point in time before Wall Street Bets became really famous was just look at the tickers and look at how much discussion was happening around a specific ticker, and that would hint to you that you can expect volatility premiums to increase just because like these guys go out and they buy options, and they buy really dumb options that have a lot of effects on market makers and have a lot of effects on people who sell options. It just causes certain behaviors. Like these price spikes that you see in the market are completely driven by where these guys are trading. And then on top of that, you have hedge funds who are piling into these as well to help drive some of these moves. So that was originally like before all this became really popular back in, maybe June of last year. I noticed that these guys were sort of onto something and that people were just printing money left and right selling Apple calls, right?
I think you mean they were buying
Yeah, they were
Apple
buying them.
calls.
Yes, yeah. So like that was where so seeing these kinds of things, you learn to like follow a trend, this, that, or the other, and sort of like the last big huzzah that really worked amazingly well was, I would say, the GameStop trade, and then because that it wasn't just that trade. I mean, there were like 5 or 6 other names that were listed that were all squeezy stocks. Like Bed Bath and Beyond was one. Fizz, which was a seltzer company, was another one. There's a whole bunch of names that were sort of like there in different places that all squeeze at the same time. And then you suddenly start seeing some of these more, what I would call like bogus, like non-squeeze stories come up and become really popularized. So like one of them was the whole silver squeeze.
Right, like that whole thing came up, and I guess from my perspective, that didn't ever really seem authentic and genuine. There was sort of this conspiracy narrative that the bad hedge funds were trying to distract Wall Street bets and like squeeze silver instead, which might have some legitimacy to it. Like one of the things that I do find interesting is I think there's a lot more sort of psyops or people like trying to game that forum than meets the eye.
Yeah, so the silver squeeze is one example. AMC originally was like that because I don't think AMC back at that time had as much short interest as it does like now, for example. Right? Like the short interest now appeared because there was run up in the price. BlackBerry is something that like sort of never made sense to me entirely. They are trying to push a narrative about that. There are a lot of these narratives where clearly people like these stocks are just kind of coming up, And then the entirety of Wall Street Bets has turned into a pump and dump scheme, basically.
Yeah, yeah, and there was definitely, I thought, some. I mean, I hesitate to call it wholesome, but there was an aspect of like GameStop in particular that it had a variety of factors going for it that don't necessarily exist anymore, right? One was this really odd synthetic shorting over 100% of the float that just made it kind of like shooting fish in a barrel to squeeze it. The other is that you could really argue that they were a value play, right? We're about to open back up. They're also transitioning the business online to retail. And like, I don't know the financials, but if I recall, there was kind of an argument that maybe GME is sort of a value stock as opposed to, say, BlackBerry, where I think it's really stretching to say, yeah, BlackBerry is going to turn around and just start printing money and be really profitable. Yeah. Like, what do you think about that?
Yeah, so I mean, I think that like GameStop had a lot of things going for it. The biggest thing that happened to GameStop though was that the price went up to, $400, $500 because that effectively let them issue shares to pay off their debt, right? Brian Cohen coming in and taking over the company is big news, and there's a lot of potential there. I mean, the question is the potential. I don't actually think this matters because pricing is not value, but like is how much more can people push up the price by buying is really what GameStop at this stage what the question is. But with something like AMC, for example, given the amount of debt they have, I can't like I don't and given the narrative of like I don't know what you're going to do to a movie theater to make a movie theater more interesting in an era where Disney is no longer releasing films in theaters and is releasing them directly to people at home, right? Like I don't. That's where the sort of the breakdown is happening for me. Is that like I don't see anybody revolutionary coming into GameStop, not GameStop, excuse me, to coming into AMC and transforming things. BlackBerry is kind of the same thing. It's like the same corporation doing the exact same things that it's been doing for years. I don't see what the catalyst is. Now, that's not to say that there can't be a catalyst. And I think that if BlackBerry corporate is clever enough, they'll find a way to capitalize off of this excitement because clearly that has value. And the example of a company that is, trying to do this is Volkswagen. Like Volkswagen is actively trying to create a more trendy social media presence to drive people to invest in them as opposed to things like Tesla. And it's a strategy. The whole thing is I don't see BlackBerry doing that. And maybe that's the point. Like the inflection point where I would buy that stock, consider buying it for like or just to chase it is when you see some kind of corporate news comes out that signals that they want to play ball with Wall Street Bets to try to pump their stock.
Yeah, I remember there was this moment sort of after the peak. You didn't really know if it was the peak or not at the time, but it was near the peak in January. And Cuppy, Harris Kupperman, was on Market Huddle and he said, well, now's the time where I'm just going to sell a ton of volatility on these names and just go to the beach. And I'm just going to sell volatility and just harvest that premium because while the stocks might thrash around, they kind of go all over the place. I mean, I don't think GameStop's going to $5 a share. And yet you can sell these options where it's still risk, right? But if your thesis is GameStop's not going to dip below, I don't remember what the low was, $50 or something like that, you can make a ton of money selling volatility.
I mean, I got pissed at Cuppy and I actually tweeted at him that thanks for telling the world about my trade, basically, right? Like he was advertising this as a trade, and I'm like, why are you doing this? Like I'm making so much money just doing this, and it was like you could sell there was a time where for 2 months, right, you could sell like a $40 put for like $4 or $5, something like that, which is insane, right? And if there's a volatility contraction, you'll take your money and go home. And if the price moves again or balloons again, you take your money and you go home. And that's exactly what happened, right? So, I mean, those are my favorite plays across the board is, when something swoons, there's a point where it's going to come back to earth. And, selling vol around that is it seems like a no-brainer. I mean, but it's not a free trade, right? Like you need to make sure that you're out of the money enough, and you need to make sure there's nothing else that you'd rather do with your money.
Yeah, well, it's a flip side of that convexity where when you buy an option, you have limited risk. The most you can lose is what you put down for the option, but unlimited reward. That thing could go to the moon, and you could make a ton of money. But on the other side, when you're selling that, you sort of take the opposite position, obviously. And so you have this unlimited risk, but then also, if the stock goes nowhere, you have that juicy premium that you get because these implied volatilities are so high.
Right, but the risk is not unlimited. Like saying unlimited risk it doesn't have to be that way because you can always define your risk unless you think a stock price could go negative. That's the thing. Is it like where and what you do this on are things that you're fairly comfortable with, where you're placing your strikes. So where, there's a probability distribution that is implied by the option curve. There are times where, for example, if you sold a straddle on AMC recently, the amount that you would get paid was enough to where your entire downside is covered. Right? Like the price could go negative in theory and you would make money even though that's not possible. Whereas your upside is where all your risk is. So it is possible to define your risk and take the trade, and then probabilistically, if you do the trade enough times, you'll come out with money in your pocket in theory. The problem is that there are times where if you do it at the wrong time, you're basically the whole collecting pennies and the steamroller analogy, right? Like that becomes very, very true where you're just collecting these small amounts only to like one day have that thing that has a 30% chance of happening that wipes out everything that you've made. So, that's why sort of like there's this balance between making sure you're in a right place, making sure that there's some technical factors that maybe justify where you are, making sure that you're collecting a rich enough premium so that after volatility contracts, if you do have a down, like, I've sold GameStop premium. There were days where I suddenly had like a 25% drop in the amount of premium that I collected. And had I sold volatility on that day, I would have been in a lot of trouble. Right? So like there are things like that where there's a sort of an art to timing this to where you're defining your risk and making sure that you're getting paid for that convexity.
Yeah, 100%. It's like anything else, risk reward, right? Where one of the things we kind of talked a little bit about is that over the past year, we've now slowly started to enter a climate where volatility is just, there's been so much selling that it's now back down to really, really low levels, meaning that you don't have as much of that kind of meat on the bone or cushion in the premium to protect you if you're going to sell it. So different environments, different things work.
And this is why I'm not as fond of selling vol anymore. And as I hope this past week is like an example of that.
Oh my God. Yeah. If you were like selling volatility on the long end of the curve or something like that, like you probably got ran over. And so we kind of briefly mentioned Cuppy. And one of the things we talked about was how you investigated one of Cuppy's hypotheses. So Cuppy has some of these pet trades that he'll talk about. And one of them, I'll just go ahead and say what it is he's buying newspaper stocks. And that's kind of one of those things I think a lot of people look at and say, that seems crazy. That's because they're dying, and they're not adapting to the digital world, or are they?
Yeah, I think this whole thesis that print media is dying is something that has been baked into the cake, and really during the pandemic accelerated that the selling of those types of names. So if you pick any number of print media stocks, look at them like a magazine business or a newspaper business, and you'll see that they all got hammered by the pandemic, and now there's like sort of like this questionable recovery in price compared to a lot of other things that have recovered substantially. And I think the way to think about this trade is in part that it's a space that not a lot of people are talking about. When people talked about digital acceleration during the pandemic, the primary focus was on, work from home, people moving out of cities into suburbs. And this, the narrative around things like newspapers accelerating to digital is something that hasn't really been talked about. The narrative around newspapers in this type of environment realizing that they can't depend on advertising to survive, that's gone away. So they had to all sort of invent a new business model very quickly. And the easiest one is to basically turn into a paywalled subscription service. So pretty much across the board, you see that, at some point in time over the past year, every single one of these services made a transition to where they paywalled their digital services, or people who were buying their print media have now become converts to their online media, and they can monetize those customers in a very different way. And you see this sort of acceleration of digital subscribers.
Right. They couldn't just cross their fingers and hope that it worked out to sell more physical paper anymore. They had to adapt. And so most of them finally kind of got their act together and put up paywalls and figured out
Yeah,
how to get
exactly. It's
subscribers.
it's not like during a pandemic when toilet paper is running out, newspapers are going to toilet paper business, right? Like that's so they have to come up with some other thing, another way of monetizing it. They're not going to sell it to you to wipe your ass, right? So so especially when, like, if you think about it, like running you have to, during a pandemic, you have to actually run a newspaper press, like a newsprinting press too, right? How can you do that during a pandemic? So there's a lot of like structural reasons why they had to accelerate this move towards digital. They had to cut spending in a lot of ways. So you had a lot of these businesses, like efficiencies gained through reducing staff, and efficiencies gained through focusing primarily on digital media, and just this expansion of subscriber growth. And one of the things that sort of predicted this trend was to actually look at how much any specific property that one of these companies owned, how do articles from those property, how do they perform on Reddit? So this is, my whole hypothesis was that if you were to look at a local newspaper, something that would show you whether or not digital adoption is working is, are these articles appearing on Reddit, and are they being posted, like, not by the brand itself but by just normal people?
Yeah. Kind of the wisdom of the crowds type of approach, where you look and you say, well, these are doing well, and just follows that that's the start of the funnel, right? The more they get in front of people on Reddit or wherever, the more they're going to convert and, get new subscriptions.
Yeah, and I was doing it on Reddit and on Twitter. I got banned from using Twitter's API because I was making way too many calls trying to figure out what to do. And the neat thing about these small newspapers are, on Reddit at least, and even on Twitter, that they're so small that, like, the total number of posts on Reddit that are made from those websites are is nothing. So you can actually make API calls going all the way back out to 2018, right? And you can see that far back how many posts there are, because, like, the total number of submissions don't exceed the API call limits, right? Whereas, like, if you want to look up for New York Times, you get overwhelmed immediately, and you can only go back, like every day you can only get 100, like 1,000 posts maybe for that day, right? Whereas for these, you're going to get 1,000 posts, and it goes back in time, like, very nicely. And then every one of these media companies owns maybe 20, 30, 40 of these papers, right? So for every single one of those, you can just aggregate across all of them and see what the moves are. And you'll see that, like, some of them, like, sure enough, right around, June, July timeframe, you start to see a move up. There are other ones that had a spike as recently as in January, because that's when they figured things out, right? And that for me is why I think this is an interesting trend to follow, and it has a relatively asymmetric bet because nobody cares about newspapers. And if they start to make money, then their valuations should go up, because they're not being priced according to the amount of traffic they're actually getting and how many what their subscriber growth should be if the trend continues. So I will say it all depends on the trend continuing, because a lot of these things have been priced for a turnaround. So, one of the companies that Cuppy likes to talk about a lot is Lee Enterprises, and that stock has appreciated a lot since its lows. And really, I think it's still a little bit underpriced here, but the run up in the future depends on if they can maintain their growth going forward, and that's something that I haven't seen yet. Like, it kind of looks like things are at least remaining stable; they're not going down. So I'm really interested to see if there's anything that they can do to continue to accelerate the current trend.
Right. Like this thing was just left for dead, priced as, oh, this is all done forever. Kind of like energy companies in March 2020, that kind of deal. And then everyone sort of started to realize, oh, there's actually some potential here, and we need to sort of reprice this back up. It's up 121% year to date. So if you bought Lee Enterprises in January, You doubled your money, more than doubled.
Yeah, and I mean, I still think there's room here. Like I said, I still think there's room, like, you know, for this to, because just if you compare their performance now and what they're doing now to the like everything in the past, there's reason to argue that this is still underpriced. But like I would expect for this to correct potentially before anything happens. So and again, like I want to see those indicators prove to me that like people are excited about the papers that they own.
Right. Like it's just like you were saying earlier, the risk reward is not necessarily in your favor right now because everyone did kind of look around and say, oh, like we need to bid up newspapers, like let's get some Lee stock. And so since everyone sort of had that turnaround and it got repriced, the risk reward just isn't the same. You know, it's in January you were ahead of the curve. Now everyone else already kind of figured out, okay, we can reprice these, and so it's probably much more efficiently priced. And then that's always the question: is does it keep going or does it not? And, you know, I mean, Lee has been flat or down since like you know beginning of May. It looks like so peaked in May. So we'll see. I gotta love a good value play, right? Like this is like a PE of 13. I always like throwing money into those kind of stocks instead of just like Tesla or something where you know it's a cash furnace. You know, it's just hopes and dreams and future growth projections fueling that. And if even the teeniest little thing, that thing could really take a nose. Exactly what happened, sort of like first 3-6 months of this year. Although the action like the past week is fascinating. I mean, what's your take on that? Like for anyone who doesn't follow financial markets really closely, basically what was previously a slam dunk trade in the past kind of maybe 4 months of betting on these kind of rising yield type of stocks like energy, materials, financials, and that kind of thing, totally got the Fed had a meeting and they came out as quite hawkish. So they indicated that they might raise rates sooner than people thought, and that kind of caused all these dislocations in the market. The long end of the curve started selling off really aggressive. And yeah, it just sort of we're rallying again. That's something we haven't seen for a while. So yeah, what's your take on what's going on there?
Well, I will preface like this by saying I'm very, very new to all this, so I don't really know what I'm talking about at all, right? But my thought process is that I think for sure there were, just having listened to a lot of people on different trading podcasts, that everybody was had a there was a specific view that was very predominant, which was that inflation is coming, it's coming with force, short the dollar, short yields, right? So all things coming together and so many people being on one side of the trade, I think it's inevitable that, you know, in overcrowded trades, things unwind at some point because there's way too many people on, you know, looking at what happened to bonds and seeing that some people are talking about, there's speculation that somebody got hammered really bad and just had to unwind a lot of their positions, right? And you know, everybody's over levered, so when things happen, they happen big. um, what's going to happen in the longer run, just yeah, I don't know what's going to happen in the longer run. My suspicion is that if like growth does not continue and things, you know, unemployment does not continue on the current path, then the Fed will probably decrease rates again. If the market ends up acting really, really badly, or there end up being problems from this announcement that are like real, then you know the Fed will react again because they are very data driven, right? That's what they say, is that we're data driven. So that means they're going to react to how the markets react to all this news. Um, the tech stocks rallying is the exact same story. Is that like everybody had said that, you know, inflation is coming, therefore growth is dead because explain things. Okay, so you have interest rates. Interest that without taking any risk, every year I'm going to give you a certain percent on your money. So I have sheets of paper that will give you a return. An alternative investment is something like gold, where I will not give you, it's a rock that is precious, right? and limited in supply, and you do not get a return on that rock. So when do you buy the rock? You buy the rock when the amount of interest that you expect to get from that paper is less than inflation, because you think the price of the rock will increase faster than these sheets of paper that the government can just create. So it's not quite a zero coupon bond, but it has the behavior of it, right? With sort of a somewhat built-in inflation hedge. But the minute that real rates end up going up, then that happens. Now let's look at growth companies. What are growth companies? Growth companies are the promise of future cash flows. Okay, so if exactly, so in theory, if people are shorting bonds, which means that real rates are increasing, right? That means that these long duration assets are now worth less in the present. And I have a great Reddit post that goes through this, right? And that's where you know that like you no longer want to own that thing that gives you money in the future when you can get sheets of paper that give you money today, right? That's where that trade-off stops. It stops becoming less worthwhile. So now that there's been this unwinding of those trades, there's been an unwinding of, they say flattening of the yield curve is happening because 5-year rates have gone up and the long end is coming down, right? Like all that is happening. Now you're living in this world where, okay, well, maybe we are not afraid of rates in the future being so high up that maybe it does make sense for me to buy growth, right? You can argue that. The way that what I think is actually happening is that, like, yes, that's true, but that's probably why everybody was positioned the way they were to begin with, which means that when the unwinding happens, like, naturally there is the opposite. Like, where are you short? We're short tech stocks. Where were we long? We were long commodities. So what do you have to do is you invert that, right? When there's an unwind, right? When something stops working, right? So there's a natural, like, yeah, there's some logic behind it, but at the same time, there's just people are inverting their traits.
Yeah, like speaking of short squeezes, same kind of thing, right? Just like tons of leverage piled into all these same trades, and then Wall Street Bets starts buying a bunch of Apple calls or something like that, and that might
Yeah,
exacerbate
I mean,
it.
look at the move in the U.S. dollar that happened during the Fed announcement. Like, that's an insane up move that happened, right? It just shot right up just because they announced that they were going to, tighten a little sooner. And that to me is crazy.
In like
Yeah,
2023.
yeah,
That's the crazy part, is they're like, we're going to get really tight. And, we're talking about like a couple rate hikes. Like, this isn't really a giant thing. Like, they're being very careful to say, like, we're going to keep like very low rates for a really long time. We're going to keep doing QE. And yet the market just had this like massive reaction to what's happening. I mean, I don't know what, I'm kind of like you. I'm a noob at all this, and I'm not a finance pro by trade. I'm a programmer guy. But what it definitely looks like to me is that the Fed kind of signaled that they do actually take excess inflation as a threat seriously, that they will raise rates if that's called for. And while they're being very accommodative, they don't want to spook the market, that they are not going to necessarily print everything into the ground and have 10% inflation and not be worried about it, right? Which is kind of a meme that's out there. Like the Fed is going to just keep printing and never raise rates, even if we see inflation. I think they kind of signaled a hawkishness that people didn't expect.
yeah. Like I said, I think that they were. I mean, you give inflation prints, the job numbers are coming in okay. I mean, they've been very, very clear about what their criteria is for rolling off any Jerome had discussions with David Rubin, who he's like a really big financier. They sort of like talk about like what are the step by step, what are the steps in the unwinding of the like of all the asset purchase programs they're doing. Like, what are they going to stop, are they going to start selling treasuries, for example, like doing QE, questions like that. And they've given very clear answers. Sort of the question becomes like, okay, what they're going to do. What's the timeline going to be? And I feel like, people didn't expect 2023. But again, like, I don't think it's far fetched if they believe that they're getting closer to where they want to be. And apparently, some percent, like a higher percentage of all of the governors decided that this is what we think is best given the current circumstance. And it follows their own script. Like, I mean, their script is just being moved up a little bit because they think that things are moving forward a little bit faster And I haven't read enough about this, but I mean, things slow down a little bit, right? And if this is enough to cause a slight deflation in asset prices, and then later on they'll have, maybe some more policy space to say, yeah, we're going to delay the taper for a little bit longer. Like that's something they just created for themselves potentially. I think that's might be what happened, right? So like, say unemployment remains stagnant through the end of the year. Say that we don't have um, really crazy inflation the way that they were expecting, and wage growth remains stagnant. Like, what do you think they're going to do?
Well, they're going to ease. I mean, that's the thing about this Fed is I mean, Jerome Powell started off being a hawk and he raises rates. He was doing quantitative tightening and they said, oh, it's going to be like watching paint dry. It was not. The markets did not like that and they had to taper tantrum. And then, they had to walk it back.
Right. So my only thing that I can say is I don't know what's going to happen. I know it's going to be data driven, and I'm pretty sure that if people keep putting a lot of money into these trades, that there's going to be a lot of volatility. Those are the only two things that I am certain of. Is there's probably way more volatility, and it will probably, like, their behavior going forward is going to depend on what the inflation numbers look like and what the unemployment numbers look like, which isn't saying a lot because that's exactly what they're saying. But I mean, I think that's the point, is that it's exactly what they're saying. And now we're sort of learning what numbers.
Yeah, absolutely. And I mean, I think one of the memes that's flying around out there that I think there's probably some truth to it is that there are some people in the Fed that they're hawks at heart, and they probably are worried about rising inflation, and they know we better start kind of prepping people now, and hopefully kind of jawbone everything so that the various markets, like particularly credit, I think that's what they really worry about. In the stocks, I don't think they really care as much, but they want to make sure there's no giant discount in the credit markets, and then they have an even bigger mess to clean up. So I definitely think that there's a little more hawkishness there than people tend to think, but then they're just, as always, they're kind of boxed into a corner, right? They couldn't even raise rates to, like, what was it, 150? When I think it was 150 Fed funds rate, it was when they had to start walking it back down. And so um, we'll see. Maybe they can engineer a soft landing out of it. We should all hope. We should all hope and engineer a soft landing out of all this, because otherwise, I mean, who knows what happens? We could go the way of Japan, or have all sorts of weird fates. But I think that's getting to be about time. So thanks so much for coming on and sharing your views for us. And if people want to check you out, they want to learn more, where can they find you?
They can find us. It's YOLO Quant on Twitter and Reddit are the two best places. And please excuse, like, me on Wall Street Bets. I'm a little bit vulgar there, but that's sort of the culture.
That's right. When in Rome, do as the Romans do. So when in Wall Street Bets, we do as the Wall Street bettors do. And so, yeah, thank you very much. That'll be all for